Hey everyone, welcome back to This Explainer. Today, we're tackling a massive, highly testable topic for your CMA exam, internal control. I want you to picture a business as a giant castle. It's full of valuable assets, sensitive data, and tons of complex daily operations. Well, internal control, that is the ultimate business fortress you build right around that castle. It's literally the blueprint that keeps your operations running smoothly, keeps the gold locked in the vault, and keeps the enemies, things like fraud and error, completely outside the gates. So think about this for a second. What actually protects a massive business from just collapsing under its own weight? I mean, how do organizations process millions of transactions, employ thousands of people, and somehow survive without catastrophic errors or corporate fraud bringing them down every single day? Well, the answer definitely isn't just good luck. It's a meticulously designed system. All right, here is our roadmap for today. We're looking at 6 key areas to get you exam ready. First, defining internal control. Second, the scope, administrative versus accounting. Third, the 7 basic elements. Fourth, types of internal controls. Fifth, we'll break down check, audit, and control. And finally, number 6, we'll look at the inherent limitations. Let's dive right into Section 1, defining internal control. Okay, so Standard on Auditing 265 really gives us our formal blueprint here. Internal control is not just some static manual sitting on a shelf. It's a living, breathing process. It's driven by the board, management, and other personnel. And its main job? To provide reasonable assurance on 3 major objectives. We're talking the reliability of financial reporting, the effectiveness and efficiency of operations, and compliance with applicable laws and regulations. Basically, it ensures the orderly conduct of business, adherence to management policies, and, of course, the safeguarding of those assets. Moving on to Section 2, the scope of internal control, specifically administrative versus accounting. So, internal control actually comprises 2 distinct wings. Administrative control is really the operational side. It ensures adherence to management's plans and procedures, so focusing on things like the production process, quality control, and pricing strategies. Accounting control, on the other hand, focuses purely on the numbers. This ensures transactions are recorded adhering to established accounting policies, checking arithmetical accuracy, maintaining proper books, and rotating staff duties. And hey, quick tip for the exam, accounting control is further divided into 2 very specific subsections, internal check and internal audit. All right, let's look at Section 3, the 7 basic elements. These 7 elements weave together to form a really effective safety net. First up, you need clear organization plans, using things like flowcharts to specify duties and authorization powers. Second, and remember this for the exam, competent personnel. This is the absolute most important element. If your employees aren't competent and efficient, the whole system fails. Third is division of work, allocating tasks by skill and quality. This naturally leads to the 4th and 5th elements, separation of operational responsibility from record keeping, and separation of custody of assets from accounting. Think about it. If you hold the physical assets, there is no way you should be doing the accounting for them. 6th, you need proper authorization for all activities. And 7th, you wrap the whole thing together with regular managerial supervision and review. To help visualize this whole environment, take a look at the COSO 2013 framework. Notice how it acts like a giant twisting ribbon. It perfectly maps out how the control environment, risk assessment, and monitoring activities physically interlock throughout an entire organization. It's pretty cool, actually. From governance and culture on one side, twisting all the way through to enhanced value on the other, it shows that internal control is completely woven into the fabric of the business, not just bolted on as an afterthought. Now, for Section 4, types of internal controls. So we basically have 2 main types of guards enforcing our rules. Preventative controls are proactive. They discourage errors or irregularities from ever happening in the first place, like that division of work we just talked about. By dividing responsibilities, fraud is literally stopped before it starts. Detective controls, though, are reactive. They find the error or fraud after it's already occurred. Think along the lines of internal audits or physical inventory counts. You absolutely need both because your detective controls provide the actual evidence that your preventive controls are working the way they're supposed to. Okay, Section 5, check, audit, and control. Remember earlier when I said internal check and internal audit are subsections of accounting control? Well, here is how they differ. Internal check is an automatic, simultaneous prevention system. The work of one employee is continuously and automatically checked by the next in real time, which totally eliminates duplicity. Internal audit, however, happens after the fact. It's an independent appraisal to detect frauds or errors once the work is already done. And internal control, that's the massive umbrella over both of them, with the main thrust of fixing responsibility and ensuring overall adherence to management policies. You definitely want to lock these differences into your memory for exam day. Finally, let's wrap up with Section 6, the inherent limitations. Here is the hard truth. Internal controls can provide only a reasonable assurance that objectives have been achieved, not an absolute guarantee. Just reasonable. You could have the best division of work in the world, but if two employees decide to collude and commit fraud together, well, the control is bypassed. There's always the potential for human error, maybe a misunderstanding of instructions, or even management overriding the very controls they just put in place. Basically, the system is only as perfect as the humans operating it. Which brings us to a pretty provocative question for you to take away today. If internal controls can only ever provide reasonable assurance, how do we prepare for the risks that inevitably slip through the cracks? Answering that requires a major mindset shift, moving from just basic control to a holistic risk management approach, really anticipating the unexpected. So keep that critical thinking cap on as you continue your CMA studies. You've got the blueprint to master internal control on exam day now.
Today we're breaking down the exact blueprint of internal control objectives and advantages. These are core concepts you absolutely need to master for test day, so let's get right into it. So, let's kick things off with a pretty foundational question. Why do organizations actually need a system of internal control? Well, it goes without saying that every organization needs controls just to achieve its predetermined goals. But beyond just hitting those basic targets, what specific superpowers does this system give a business? As you'll see, it plays a massive, multifaceted role in an organization's daily life.
To unpack that, we're going to follow a simple roadmap today. We'll start with the general objectives, move on to the SA 315 specifics, and finally, look at the key advantages.
All right, diving straight into Section 1, the general objectives. Starting with the big picture, let's look at the first 4 general objectives together, because they definitely share a common theme. Notice how heavily they focus on the rules of the game. First, you're making sure business transactions only take place based on management's general and specific authorization. Second, you're ensuring a sequential, systematic recording of every single transaction. Third, it's about making sure those recorded transactions fairly represent actual economic events, meaning they're lawful and properly authorized. And fourth, ensuring all valid transactions are accurately recorded right in line with your accounting policies and standards.
Now, what's really interesting here is the demand for absolute precision. When we talk about sequential and systematic recording, internal control is doing the heavy lifting to ensure every transaction is logged with the accurate amount in the respective account and, crucially, in the exact right accounting period in which it actually took place. For your exam, just remember that internal control is essentially the guardian of the accounting timeline.
Moving into our next bucket of general objectives, the focus shifts a bit toward physical and operational realities. Objective 5 is all about providing security to the company's assets, keeping them safe from unauthorized use. Number 6 is highly proactive. It's about reviewing the workings of the business to locate weak points in operations so you can actually take corrective measures. And finally, number 7, ensuring the optimum utilization of the firm's resources. That last point is crucial to highlight for your exam. Internal control isn't just a defensive mechanism to stop bad things like errors or misuse. It's actively about optimizing the good things. It ensures that the firm's resources are being utilized to their absolute best potential. Okay, moving right along to Section 2, the SA 315 specifics.
Having covered the broad goals, we now have to look at a specific auditing standard that you must know inside and out. It's SA 315, which covers risk assessment and internal control. If you see SA 315 pop up on your exam, you need to open a separate mental folder right then and there. While it shares some DNA with the general objectives we just talked about, SA 315 explicitly advocates for 4 very specific objectives of internal control. Let's map out those 4 specific pillars. 1. Ensuring transactions are executed exactly as per management's authorization. 2. Ensuring transactions are recorded in a proper way to facilitate the preparation of financial information and to maintain records of assets. 3. Ensuring assets are protected from unauthorized use, sale, and things of that nature. And 4. Ensuring assets are verified at frequent intervals.
This brilliantly illustrates the overlap and the differences that examiners absolutely love to test. While the general objectives include broad operational things, like finding weak points and correcting operations, SA 315 has a much narrower, laser focus on facilitating financial reporting and protecting and verifying assets. In fact, I want you to mentally highlight this exact phrase to ensure that assets are verified at frequent intervals. This requirement for frequent physical verification of assets is a major standout when you are specifically discussing SA 315. Lock that one into your memory for sure.
All right, let's bring it home with Section 3, Key Advantages.
Once an organization successfully implements these objectives, what are the concrete day-to-day advantages they actually experience? You'll want to take a mental screenshot of this breakdown. These are the 4 core advantages of a good internal control system, perfectly paired with the exact key impacts you'll likely see in multiple choice questions. Let's walk through each one to see exactly how they function in the real world.
Let's break those down, starting with the first 2. Number 1 is efficiency, effectiveness, and economy. A strong system ensures resources are utilized only for their intended purposes, which completely helps overcome the risk associated with the misuse of the organization's funds and other resources. Number 2 is the prevention of errors and irregularities. By detecting issues in a timely manner, it actively promotes highly reliable and accurate accounting records.
Furthermore, the third advantage is that a good internal control system actively safeguards assets from irregularities or outright misappropriation, keeping the organization's resources fully protected. But the fourth advantage is the one that sometimes surprises people: employee satisfaction and productivity. Believe it or not, internal control actually plays a massive role in enhancing workplace dynamics.
Let's look a bit closer at why that is. It might seem counterintuitive. You might think controls would feel restrictive to staff. But by clearly segregating duties and delegating responsibilities, it actually enhances employee satisfaction and productivity. When everyone knows exactly what they are responsible for, the whole operation just runs so much smoother.
So, as we wrap up this explainer, I want to leave you with a final thought. Keep these frameworks, the general objectives, the SA 315 specifics, and the key advantages, fresh in your mind for your exam. But beyond passing the test, ask yourself, as a future CMA, how will you leverage these exact controls to become the professional who safeguards and optimizes your organization in the real world?
We're talking about structured internal controls. So whether you're running a scrappy little startup or managing a massive corporation, understanding the anatomy of these controls is literally the difference between survival and disaster. Let's get into it. Okay, let's kick things off with a fundamental question about your business's vulnerability. You know, it's incredibly easy to just assume you're safe because, hey, you haven't caught any major errors lately, right? But there's a massive difference between actively blocking a threat at the front door and merely sounding the alarm after the damage is already done. Today, we're going to unpack how to build both of those into your organization. So, to start, what exactly is an internal control? Basically, it's the complete set of procedures designed by management to safeguard assets and ensure reliable financial reporting. But it's not just an accounting thing. It spans administrative controls, operational efficiency, and even legal compliance. Think of it as the essential framework that guarantees your business actually achieves its goals. Here's our roadmap for today. We'll look at why internal controls matter, dive into preventative controls as your shield, and detective controls as your alarm. Then we'll explore how to evaluate them, look at 4 specific techniques, and wrap up with building a bulletproof system. All right, let's jump right into part 1, why internal controls actually matter. Look, these controls are absolutely not just bureaucratic red tape. They are vital business tools. They're what protect you from internal carelessness, inefficiency, and flat-out fraud. Without this strong foundation, your company's objectives aren't just delayed. They are constantly at risk of being completely derailed by internal weaknesses. Moving on to part 2, let's talk about preventive controls, which act as your organization's shield. Preventive controls are specifically designed to discourage errors or irregularities before they ever happen. Management builds these around things like physical safeguards, clear authorization requirements, and strict segregation of duties. Honestly, from a quality standpoint, these are your most essential tools. Why? Because they're highly proactive. They force your team to emphasize quality and do things right the first time around. To make this a bit more concrete, imagine your own accounting process. First up, segregation of duties. You really never want the exact same person who authorizes a purchase to also record it in the ledger and handle the actual cash. That's a recipe for disaster. Next, we have approvals and authorizations, basically requiring a supervisor to validate that a transaction actually conforms to company policy. And finally, security of assets. This simply means restricting physical and digital access to equipment, cash, and inventory so only the right authorized folks can get in. Okay, let's switch gears to part 3, detective controls. This is your alarm system. So there's a really clear contrast here. While preventive controls emphasize proactive quality, detective controls are built to find errors after they've already happened. Let's face it, you can't prevent every single mistake or fraudulent act, right? Sometimes the shield takes a hit, and that is exactly when you need your detective controls, your internal alarms, to trigger immediately so you can jump in and fix the problem. So what do these reactive alarms look like in practice? Well, one example is management reviewing current performance against budgets or forecasts. If something looks unexpectedly high or low, boom, that's your alarm sounding. Another great example is reconciliations, where an employee compares different sets of data and investigates any discrepancies. And finally, physical verification. By actually walking into the warehouse and physically counting the inventory, an auditor can quickly detect if any misappropriation or theft has occurred. There's actually a really fascinating symbiotic relationship between these two systems. Your alarm system basically proves whether or not your shield is working. Think about it. If your detective controls are constantly catching errors during reconciliations, well, that's a massive red flag that your preventive controls are failing at the front door. Detective controls provide that essential feedback loop management absolutely needs to gauge the true health of the business.
Bringing us to part 4, how to evaluate these controls.
It is one thing for management to design a beautiful, flawless security system on paper, right? But it is an entirely different challenge to ensure those controls are operating effectively in reality. So, how do auditors systematically evaluate your entire control system to find those hidden gaps? Let's dive into part 5 and look at 4 specific evaluation techniques used to do just that. Auditors generally rely on 4 distinct methods for evaluating internal controls, and each has its own ideal use case. We've got narrative records, checklists, flowcharts, and internal control questionnaires. But regardless of the method used, the ultimate goal always remains the exact same: evaluating whether your business practices are effective, efficient, and compliant. Let's take a closer look at each one. First up, the narrative record. This is quite literally a complete and exhaustive written description of the system. It's actually a great starting point for smaller businesses where a formal control structure is lacking, but there's a bit of a danger here. A beautifully written paragraph can sometimes mask a severe weakness, simply because gaps are incredibly hard to spot when you're just reading through dense text. Meanwhile, checklists and questionnaires provide a much more systematic evaluation. A checklist is exactly what it sounds like: a series of yes, no, or not applicable instructions followed directly by the auditor to ensure they don't miss any steps. But the internal control questionnaire, that is the most widely used tool. It involves handing out pre-designed questions to various staff members at different levels. The brilliance of it is that it's typically formulated so a yes answer means everything is satisfactory, whereas a single no acts as an immediate flare, highlighting a potential weakness for the auditor to investigate further. Finally, we have the flowchart. This is a pictorial representation that visually maps out the entire system, allowing the auditor to gauge the broad picture of all controls in a single quick glimpse. A complete flowchart shows exactly who is raising documents, how those documents travel through various departments, and where the physical goods are moving. By laying it all out visually like this, missing controls, duplicated efforts, or dangerous concentrations of power become glaringly obvious. All right, let's wrap things up with part 6, building a bulletproof system. If there's one ultimate takeaway here, it's this: you absolutely cannot rely on just the shield or just the alarm. They must work together continuously. A truly robust system requires strict segregation of duties and solid authorizations at the front door to prevent errors from entering. But it also absolutely requires rigorous reconciliations and physical audits to catch whatever occasionally slips through. That combination is exactly what brings true assurance to management and stakeholders. I really hope this explainer has illuminated the mechanics of internal controls for you, and maybe left you asking if your own organization's defenses are truly as strong as they need to be. Whether you decide to deploy a narrative record, a flowchart, or a detailed questionnaire, the best time to evaluate your internal controls is right now, before the alarm is forced to sound on a catastrophic error.
Think of this session as your ultimate structured cheat sheet for mastering 2 incredibly important, heavily tested topics. We're talking about the inherent limitations of internal control and the super powerful system of internal checks. We're going to take all that dense, complex text and break it down into clear, visual concepts so you can walk into that exam room with absolute confidence.
Here's our roadmap for today. We'll start by tackling the myth of perfect control. Then we'll detail the 6 inherent control limitations, introduce the concept of the internal check, and finally wrap up with the objectives of internal check. Let's get to it.
Section 1. The Myth of Perfect Control.
The armor has chinks.
You know, in business, internal controls act like a shield against risks and fraud. But here's the reality check. This shield, it's not invincible. If you take away just one phrase from today for your CMA grading, make it this one: reasonable assurance. Internal controls can provide only a reasonable assurance that objectives are achieved. They are absolutely not an absolute guarantee. There is literally no such thing as a 100% fail-proof environment. So, cement that buzzword, reasonable assurance, in your mind right now.
Moving on to Section 2, 6 Inherent Control Limitations, Understanding System Vulnerabilities.
So, the crucial point is, since we know controls only offer that reasonable assurance, what exactly causes these vulnerabilities? Well, for the exam, you've got to remember these 6 inherent limitations, and it helps to group them logically. The first 4, breakdowns, judgment, management override, and collusion, these are all driven by the human element. You know, people buckle under pressure, they misunderstand instructions, or they just plain break the rules. Now, the last 2 are systemic factors. That means controls are really only suitable for common business activities, and sometimes, well, operating them just turns out to be a very costly system.
Actually, I want to pause right here and focus specifically on 2 limitations that absolutely love to pop up as trick questions on the exam: judgment versus collusion. Judgment is, well, it's an individual limitation. The effectiveness of controls gets highly impaired when a single person has to make decisions using human judgment while under pressure. Collusion, on the other hand, is a team sport. This is when internal control systems become completely ineffective because several individuals are acting collectively to alter financial data or management information in a way the system just can't identify. So one is a human mistake under pressure, and the other is a coordinated, deliberate attack.
Another massive human vulnerability is management override, and it's exactly what it sounds like. You can design the most rigorous, airtight policies in the world, but they instantly fail when high-level personnel, the top bosses, simply bypass the prescribed rules for their own personal gain or advantage. When the very people in charge of the controls just override the controls, the whole system is nullified.
Now, looking at the systemic limitations, we really have to talk about the financial reality of a costly system. Operating an internal control system often turns out to be very expensive. So, you always have to ask yourself, does the cost of the security outweigh the cost of the risk? If the actual financial losses incurred from errors and frauds end up being less than the cost of operating the internal control system itself, well then the system becomes completely redundant for the entity. It's just the classic, simple cost-benefit analysis.
Okay, so we have all these limitations, right? People make errors, technology breaks down, and fraud happens. Let's take a quick cognitive reset right here and ask ourselves, how do we actually catch these errors automatically in our day-to-day operations without completely breaking the bank?
Which brings us to Section 3. Enter the internal check, the interwoven mesh of security. If internal control is the overarching shield for the business, the internal check is the specific interwoven mesh that reinforces it every single day. According to the Institute of Chartered Accountants of England and Wales, which, yes, sounds very academic, it is essentially a routine system of instituting checks on day-to-day transactions. It's a setup whereby the work of one person is proved independently or is complementary to the work of another, with the main object being the prevention or early detection of errors and frauds.
Let's translate that dense academic definition into real-world mechanics, shall we? It basically means you arrange the duties of your staff in such a way that the work performed by one employee is automatically checked by the next staff member while they're just performing their own normal duties. It totally eliminates the duplicity of work. So, if employee A makes an error or attempts a fraud, employee B is going to automatically detect and correct it just by doing their job.
And this brilliantly illustrates the concept using a real-world example straight from the source text. Imagine a customer presents a 1,000 rupee check to a bank for encashment. As per bank policy, the work of cashing that check is divided among 3 people. Step 1. Employee 1 investigates the check and makes the initial entry in the books of accounts. Step 2. The second employee automatically checks this entry as part of their routine and sends it forward. Step 3. The third employee makes the actual final check payment. So any mistake by employee 1 is caught by employee 2, and so on. See, the abstract theory becomes incredibly concrete when you look at it step by step.
Section 4. Objectives of internal check. Fortifying the day-to-day operations.
So how exactly does this mesh fortify operations? Well, here are the core objectives you really need to know. It lessens the possibility of fraud and error, and it identifies them at an early stage. It improves workforce efficiency by implementing a division of labor.
It allows you to allocate duties easily so people can be held responsible. It helps you receive confirmation of facts, both physical and financial. It exercises continuous moral pressure on the workforce. And as a great bonus, it reduces the workload of independent auditors.
Now, what's absolutely crucial for your exam is tying these objectives directly back to the inherent limitations we talked about in Section 2. For instance, look at this direct combat mapping right here. On the left, a primary objective is to lessen the possibility of fraud. That directly combats the collusion limitation we see on the right. Think about it. By forcing a transaction to pass through multiple distinct independent employees, you make it incredibly difficult for individuals to secretly alter data. Unless, of course, the entire chain is corrupted, which is statistically way harder to pull off.
Now, what's really interesting about this slide is the psychological and operational power embedded in this simple workflow. It's fascinating. By dividing labor, you aren't just creating a security checkpoint, you're actively improving worker efficiency because people specialize. Accountability goes through the roof since duties are easily identified. And perhaps most powerfully, it implements continuous moral pressure. Knowing your work is immediately going to be handed over to a colleague who will spot your mistakes. That is a fantastic natural deterrent for carelessness. I mean, nobody wants to be the one holding up the lawn, right?
As we wrap up this explainer, I really want to leave you with a provocative thought to mull over. If an organization perfectly weaves internal checks into its daily routines, dividing every single task beautifully, can an internal control system ever truly fail? Or does the human element, the pressure on our judgment, the threat of high-level management override, the potential for complex collusion, does it always leave a chink in the armor? Keep that tension in mind. Remember that key phrase, reasonable assurance. Grasping that delicate balance between the ideal system and the messy reality of human nature is exactly what's going to help you ace your CMA exam. Good luck studying and stay focused.